Welcome to 20-Minute Leaders. Just sit back, relax, and learn from the leaders of today. It's a journey. Each one is different, unique, inspiring. Let's get started. 20-Minute Leaders is a proud supporter of Make-A-Wish Israel and Tech to Peace, and is in proud collaboration with Secret Chord Ventures, J Ventures, Riverside FM, Fusion VC, Birthright Excel, J Impact, Leap, Google for Startups, and Hippo, and in media partnership with CTech. Welcome to another episode of 20-Minute Leaders. This is a very special episode because it's not a traditional one-on-one 20-minute interview. This is a panel about the current market situation. How do we get here? How do we traverse through these weird, difficult times, whether as an entrepreneur, as an investor? How do we communicate these times to our employees and to the people in our organizations? This is a very interesting conversation with some incredible thought leaders from the industry, and I hope that you enjoy. Everybody, welcome to another awesome panel. I'm really excited to have you here talking about today's market and how the market is vastly different from what we've known and experienced just a mere 4 or 5 months ago. It feels like the dialogue has changed 180 degrees. And you're all involved with a really, really interesting report that Yael Benjamin here has put together, Startup Snapshot, and looking at exactly these questions. And so I'm excited to hear your opinions over the next half hour, 40 minutes or so. So thank you very, very much for being here. And I'd love to get to know you. So Carine, please take the stage.
Yeah, thanks for having me. I'm Carine Schneider. I'm the president of AST Private Company Solutions. We provide software called Estrella to help private companies manage their ownership. And just for background, I was a partner at PwC helping manage compensation, design, and ownership programs, was CEO of a number of tech companies, and was president of NASDAQ Private Market before I came to AST. And I'm based in Silicon Valley.
Nimrod?
Nice to meet everyone, and it's an honor to be a part of this panel or discussion. I've been a corporate lawyer for over 15 years, representing hundreds of startups from inception through to wherever they get to. And in the last 2 years, co-founded with my law firm a consulting firm for startups and entrepreneurs called Consiglieri, and a digital platform with a lot of content for entrepreneurs called Founder Runway, and we see a lot of synergies to Yael's activities and data sharing.
Awesome.
Hi, everyone. I'm Ido. I'm the CEO of American Express in Israel. My background is in engineering, and I used to run fintech and be the head of innovation in the third largest bank in Israel. I've been mentoring lots of startups in multiple accelerators over the past 8 years or so. I'm excited to be a part of this panel.
Thank you for being here. Yael, take it away.
Oh, yeah, thanks. Thank you so much for inviting us. It was great. The last report that we launched a couple of months ago, we also had the discussion, so it's great to share our insights this time. So I'll give a bit of background. Startup Snapshot is an initiative I started about 3 years ago. And kind of the whole purpose is to increase transparency in the tech ecosystem. So there's a lot of data. A lot of startups are going through the same experiences. So why not share our data, share our insights, and everyone can benefit and make much better decisions going forward. And now we really wanted to see how the whole workforce market and the startup ecosystem was really changing the past couple of months. We collected data from 450 founders and their employees to kind of see over the past couple of months how things are changing. And it was a great time to really do this research because the past couple of weeks, we're seeing a huge shift in the ecosystem. So in April, when we asked founders, hiring and employee retention was the number one challenge for the majority of founders. You know, finding the top talent, competing with the big international organizations, the unicorns in Israel. It was really an employee market. They had kind of the upper hand. But when we redid the survey a couple of weeks later, kind of everything changed. So if we're looking really at the end of May, beginning of June, fundraising became the number one kind of concern for founders. 74% said that they're really worried about their ability to raise their next round of funding. A lot of them are getting calls. They're, getting active calls from their investors, telling them to cut costs, kind of work, okay, we're going to go through a tough, no one knows how long it's going to be, but a tough year or two, kind of work to preserve your costs. And 68% of startups change their hiring strategy. The workforce is a huge, cost component. 68% really changed their hiring strategy. They either froze it or really slowed down hiring.
So a lot to unpack there, right? I think that I have to start with even trying to figure out how the hell do we get to a point where over a period of weeks, you have a shift in strategy that is so closely resembling to what happened in 2008 and the dot-com bubble. I was here in these months. I didn't feel some crazy crash coming down on me, pushing me to rethink everything I knew about the economy and about the startups that I'm involved with. What happened here?
Well, I could jump in and just say from a U.S. perspective, a couple of things. I mean, I think interest rate changes have had a massive impact. And I think if you look at 2008, the financial sector started to impact it. And I think if it had just been interest rates, investors are always looking, where's the best place to put my money? Where can I make more money? So that is just a fundamental shift for those people who are perhaps not as risk interested. They're going to say, look, interest rates are up. Maybe there's other places I want to start putting money. I'm not going to put it in, in the VC sector or others. But I think you layer on top of that what's happened in Ukraine and the inflation issues. And all of a sudden you've got micro and macro issues hitting each other at the same time. And I think we didn't have that in 2008. We really had a banking sector problem. And I think people thought we would get out of that. I think now, and again, I compare it to 2 years ago with COVID. When COVID started, no one knew how long it would last, but we all just thought, well, we'll get through this and fundamentally things are sound. I think the one thing I'll say is optimistically, and this is what the press in the US is starting to say, is that because of COVID, we're actually financially in much better space. So regular retail individuals have more savings. The unemployment rate is so low. So from that perspective, there's actually a lot of optimism there, but you layer on all these pessimism and you've got some issues.
You do. It sounds like you have something to add here as well. Nimrod, go ahead.
I fully agree. I think compared to 2008 and also COVID, it's more systemic this time. It's not confined into a specific sector and the implications are more broad because it's not just the VCs that are getting calls from the LPs that want to do something due to the interest change. It's also that inflation is hurting corporations, which are the potential customers for said startups. So it's impacting on a much broader systemic scale. That's why we think it will last longer.
Mm-hmm. I wouldn't imagine countering Carine with her experience in the NASDAQ. I do believe that there are differences to 2008 in the sense that one sort of was sourced around specific practices in spaces that are not so related to high-tech companies and affected the market, all the markets as collateral. In this specific case, I think tech is going to feel this big time. And I sort of see a chain of events that actually begins in COVID. So during COVID, there's an election to print trillions of dollars of money into the market and to get it to the needy and the poor through trickle-down policies. And when that is the approach, when people aren't paid directly for their needs, but rather the money is trickling down, top down, what happens is that people who get the money, like pension funds or larger corporations, and use it to incentivize other companies, they will have agency problems. They're managing the money, and they might be incentivized to invest it in high risk targets and assets, such as tech companies. And then you would see, first of all, tech company prices and multiples going up, skyrocketing. And then you see money going into private tech companies. By the way, for the Israeli market, that's huge because $7 trillion, even if a tiny portion of that gets to Israel, it's like a tsunami of money. And when agents of money, like GPs and investors who are investing other people's money, are investing in tech companies, and there's a lot to gain, and they're competing over a limited supply of companies of innovation, there's always sort of like the same amount that's growing steadily. they will overvalue the companies. And that's how you see large tech companies getting multiples that are irrelevant to traditional evaluation metrics. And you're seeing private companies just leveraging FOMO, sort of investor fear of missing out, to get higher valuations. Once pessimism and realism kicks in, and there I totally agree with Carine, the war in Ukraine, several botched IPOs. I think that WeWork is the culprit. I think it's one of those IPOs where people are saying, hey, do these tech companies know what they're doing and how they're valuing themselves? That creates a chain of events that causes investors to feel like, there's a big article about SoftBank this morning as well, unfortunately, and they're leveraging. And then that sort of like starts the domino effect, and people start evaluating the companies again with their right valuations. And now they're just not seeing the money or not seeing the valuations, and investors are understanding that there are no exit prospects for their companies. So they're holding on to most of their money to invest in their existing portfolio. And the market is going to get into a situation where there are going to be healthy companies that raised a lot of money during the last 2 years, and there are going to be companies that didn't make it, that the runway is now or in the next few months, and they have to do something. And I think that's a good segue also to Yael's excellent report, because that will create significant shifts in manpower. Employees are going to be moving around a lot in the next year or two.
Well, I agree with Nimrod, and what I would say is I actually go back. I'm old enough to remember 2001 as well, and so having seen 2001, 2008, COVID, and now this, you can draw some parallels. And about 2 years ago, I remember talking to the managing partner of a really, really large scale venture capital firm, and their minimum check size is 50 million and up, and he said, there's too much money. We don't know what to do with this money. And so that started chasing the SPAC market. And I think that, that's the other thing to say, the valuations are just not supported. And I think that's what we've had. So we're going to set, you've got the SPAC market, which we haven't had in previous cycles. Although 2001, you could argue the IPO market was just ridiculous. And my antenna goes up when I start to hear more than 3 people here, and people are going to take a major reset. I will say I live here in the Valley, the summers here, next 3 months off. So for these firms who are thinking, I'm going to raise, these people work hard, the lawyers work hard, the venture capitalists work hard. They're going to just say, look, the next 3 months, I don't need to make investments. I'm going to just pull back. I'm going to see what happens. We've got midterm elections coming up. I'll see in September how things are going, and money in June or July or close in August. It's not happening, and that's, I agree with Nimrod. The ones who are on the edge are not going to make it. And that will bring us a very robust merger and acquisition market, which will bring us out of this.
That's fascinating. But I do have to go back a little bit and understand what, if this is a systemic change and sort of the writing was on the wall, right? I mean, that's what I'm hearing. There was no one incident that crashed it. It was a systemic change. Maybe the rate of change was positive, so it happened quicker and quicker, like a snowball. But still, it almost felt like overnight, it became a well-known thing where the previous night, everybody were sort of enjoying the circumstance. Is this, from looking from a more behavioral perspective or psychological perspective, how do we explain this, both from founder's perspective, but also from investor's perspective?
Well, I had the privilege of meeting Carine several months back. I think that people who are in this industry, and Ido probably agrees, certainly in his position in Amex, right? That people within the industry, within the core of the industry, predicted pretty much to the quarter, if not to the month. And you're just waiting for an event that is public enough that it will affect also the long tail of humans that are looking at the market. And you're saying, okay, that's the event that's now going to set off the inevitable chain of events that are going to be the crash. So not to, sort of dismiss your know-how of the situation, but if you're in it, when the market's crashing, you sort of can predict when it's coming out of it. But it'll happen only when something external and objective to the general public happens. And
I can definitely see that. I definitely, we've had reports about this happening and thesis building up over the last year, but I'm pretty sure that if I look consistently at almost every firm, especially the really well-respected people that I'm saying, wow, they are they're really at the core of it. They kept making investments at, 35 million pre-money seed rounds,
Because
even though they may know that it's not reasonable. So how do we explain that?
because the nature of markets are not fully reasonable, right? So people were here for 2008, and I don't have any hair, but if I were, they were gray. And 2001, it's the same. Markets are cyclical, right? So we understand it's coming. No one can pinpoint the exact date. So there was a feeling for the past year and a half that the markets are and the valuations are too big, right? But no one knows the exact date, right? So there's a pressure to continue investing because you don't know if it's in a week's time, 2 months' time, or 2 years' time, right? And you feel that you're missing investments. And you have your LPs that are pushing you to leverage the funds that you're getting. It just keeps on going. That's why when there's an event that is like the checkbox for what everyone within the industry were feeling that's about to happen, they know that this is the moment, right? That's why the response is extremely quick as well.
Mm-hmm.
Yeah. The playbook's been written.
I want to...
That's the thing. Yeah. We know from COVID, you got to move quick. So I think people pulled out a lot of stuff from there and just said, okay, we're going to do this again. And I think if you read the messages carefully, the messages are, let's be careful, let's be prudent. So they're not saying, this is the end of everything. It's just, let's be smart.
Right.
Yeah. 18 to 24 months, manage the runway. That's the...
Definitely. And I want to bring in another point over here. I think, I don't know how dramatic this is going to be. I don't know, I don't want to go to a negative place, but I think that in today's market, the rules of the games kind of have changed. And startups, what we saw is that a very large percent of startups in the past couple of weeks said that their focus was on securing sales much faster. So I think, startups kind of, and it's a very healthy place to get to. Startups have to show a business model, not profitability, but some form of revenue, market validation, client validation, much faster on in the process. And I think that is some kind of a healthy correction to the market to where it was, a couple of months ago.
Great. Fully agree. I think founders now need to change their focus. They were focused in the past year and a half on growth. That means that they thought about hiring as their first priority, building features, growing the customer base. Now they understand they need to manage the runway and also show some sort of a way going forward of having a cash flow positive business down the line. So the internal focus goes from hiring towards your sales team, your marketing funnels, and understanding which features you need to bring in to be able to leverage new customers into the mix.
Definitely. I also think, kind of Nimrod and Carine, we spoke about that a lot of what kind of opportunities are coming out of here. Because, right, in COVID, kind of startups that moved fast and were able to leverage new opportunities that were forming were the ones that came out of, let's call it this crisis, much stronger. So the research found that a large percent of startups think that there's an opportunity to snatch up top talent from the public, the public companies. The stocks really, they went down. A lot of these employees, the time until, their stocks come back up to what they were before could be a couple of years. So the risk level that they're willing to take, it's becoming much similar to startup in the end. So there's the opportunity really for startups, for early stage startups that weren't able to compete and weren't attractive to this top talent before, to kind of get those guys now. Carine and Nimrod, we also spoke a lot about the M&A market.
Yeah, well, that's your original point there. There's some really good articles out there that say, show what companies came out of 2001, 2008, 2015, and like Uber, is a good example. These were all smart people who were working for bigger companies who, look at this and as you said, okay, I'm not going to make the kind of return on my public company stock that I thought in the next 2 to 3 years. So what am I going to do with that time? And that's, I think, where people are looking at what's the best return on my time. And so you're going to see coming out of 2022, you're going to see some amazing companies that get founded, and 6-7 years from now, we're going to be talking about them, because these are folks who are saying, I don't want to work for Google or Facebook or, wherever, because I'm going to go somewhere else. So it is interesting how people will look at it that way. I do think we've talked about the M&A market, and I think the acqui-hire market, at least in everybody employees. So it's a good time to kind of say, look, I'm going to get rid of the top, not top, but get rid of 5 or 10% of people who I wasn't crazy anyway. And I'm just, I'm going to kind of scale back a little bit. And so those people aren't market, but I also think these small startups are going to be looking for people to buy them, and larger companies who have cash or equity that's worth something are going to have a great buying opportunity.
Mm-hmm. Yeah, I mean, if I fully agree with Carine. I think that a startup is a lot like Schrodinger's cat. It's dead and alive at the same time. So when it's dead, it's like it's fully dead, and I'll explain it in a bit. And when it's alive, it's very much alive. So the ones that raised money, they're alive. The ones that didn't raise money and the runways in the upcoming 6 to 10 months, and their investors are not going to follow on for any reason, because their investors also have to look at their portfolio and decide who they're going to save, in a sense. So the ones that aren't going to be saved, even if they're still under the hat, they're dead. And that means that they're going to be up for sale for pretty much their debt. And if they can get earnout post-merger or some retention, then they'll have a good story to tell, and they'll be, in a sense, they'll still have a chance for some legacy. So what this does for companies that did raise 20 million and up, 15 million and up, is it gives them an opportunity to buy companies, startup companies, for their outstanding, pretty much working capital when it's left, for hundreds of thousands of dollars or for a few millions of dollars, or if they really want the tech and not only the people, maybe they need to repay the investors their principal back. So that could be 10, 15 million, but still there's an opportunity for small M&As. And if you structure them right, then these companies can come out really strong from the next year or two. And when I mean structure them right, that's not a small thing. The one thing that does normally describe these big startups, the ones that did raise a lot of money, is that they're still young companies. They're not serial acquirers. So it's not so simple to do an acqui-hire when most mergers fail and most post-mergers integration fail. That requires a lot of skills that very few tech companies in the world actually have and have honed successfully. Moreover, these startup companies that might acquire other companies for employees, for talent, let's say Facebook acquires a company. Facebook isn't raising money again from venture capital funds and isn't IPOing again. Facebook is public. So they just need the merger to sort of succeed or not succeed, and that might affect the trend of the share price, and that's it. And they're offering to the public. But if I'm a post B, post C company and I'm buying another company, I'm still going to raise money from VCs and undergo due diligence. And I'm still going to try and go public. I need to know the company that I'm buying inside out. What that means is that a lot of these deals are going to be asset deals where the buyers are buying the assets of the sellers, which create bad tax consequences for the sellers, but are simpler deals for the buyers. These deals are really interesting because you're essentially firing the employees from the seller, hiring them at the buyer, integrating them. It's a really interesting structure, and you need to go through all the motions of an M&A, HR due diligence, business due diligence, legal due diligence, and really know the target really well. You can't take gambles. So it's going to be an interesting period. There are going to be many of them, but there are going to be also many stories to learn from in the next year after some companies pursue these acquisitions.
Wow. And so if we're looking now at the landscape of founders, do you feel that there's a common understanding that there are these various opportunities that founders of Series B, Series C companies, especially first-timers, can now actually reason through? I imagine quite a few of my friends that are in Series B and Series C companies, I don't know if they would wake up tomorrow and say, wow, I can actually go and acquire assets from a competitor that until 3 days ago we were in the same, sort of similar boat.
I think it's even deeper than that. I don't think all founders understand that that's even a possibility going forward, right? I think we'll experience a few months now where most founders are actually scrambling to understand how they're dealing with this crisis. They need to understand their situation, what the VC is asking them to do, and then they'll look at their options, right? So some of them will understand that they don't have a runway and will start reaching out. And the other side of the equation, those that will take the next 2 to 3 months and lay over some people, but understand that they have the ability to weather the storm, then they'll look at the opportunities. But I think it will take a few months at least before things start to fully sink in and plans start being laid out.
I just add to what Ido said that I love the agency problem. I love where, like I said before, where investors are investing other people's money, they might overvalue a target to get the deal. It's not malicious or nefarious. It's not to make more money. It's just the way that people work when they're not making a decision on their own capital. Same goes for a CFO of a startup that raised 30 or 40 million. Sure, the company as a whole may not know what it's going to do. A CFO might think, this is going to be a cool experience for me to buy some companies if I can get them. Or a chief people officer might think that, and they might be champions of an acquisition. They might become that because there's an opportunity for them. It's still a human thing, right? The company itself is an imaginary entity. It's like us together doing something and incorporated. So I think that, most people, he does absolutely right. They've got the fear of understanding what their investors want, but somewhere, if the company raised 30 million, they hired an excellent CFO executive with experience. That CFO wants to do something that, that enables them to look at themselves in the mirror. That's buying other companies. And I think, Carine, you've bought like a bunch of companies and you like doing that. That's something you're experienced with. That's something that drives you. That you want to do more of it. Obviously reasonably and rationally, but it's a thing that it's a good thing to deal with. It's fun.
Yeah. I would say too, and I was, when I saw the Zendesk deal, I think on Friday, private equity is where in 2008, private equity kind of stayed in its lane and venture capital stayed in its lane. I think we're starting to see that also merge. So you're starting to see a whole nother different way of looking at these acquisitions. And I think private equity now is circling some of these, traditionally they wouldn't have looked at that company, but now they're starting to say, who in my portfolio could benefit from kind of a wounded animal on the side of the road? You're running out of money. You got some good people. You got some good tech. Maybe you've got some good clients. I could pick you up for a song and then, but merge you into one of my portfolio companies that could benefit from this. And that to me is going to be a massive cultural clash because you're going to start to see these traditional venture-backed companies with their culture and their way of doing things and innovation merging with companies that are maybe more traditional, older, been around a long time, weren't well operated. And now you're going to try to shove those together. And I think that's going to be another interesting, if I put my business school hat on and said, are looking for another case study, that's going to be for me another case study from this time.
So I'm wondering if we're looking from a founder perspective, if we're now in a position where we're saying, okay, so we have the runway and we have maybe an opportunity to put our heads down and for the next 12 months, not even think about the market, just build a product. Is that a reasonable sort of strategy for a founder in our position? Because to me, it sounds like a pretty amazing opportunity to say, okay, I'm detaching myself a little bit now from the market and I'm going to spend a lot of time with my team really building out an amazing product.
I think it will happen in most companies.
I started a company.
Sorry,
go ahead, Ido. Well, I was just going to say, I launched a company in 2001. I launched a company in 2008. And I launched a company in 2000 or a product in 2020. So I like to think I'm really good at finding the right timing for this. In every case, I think you kind of have to do both, unfortunately, Michael. And this is what happens with startups. Yeah, if you've got the money and you've got the talent, I think heads down, spend the next 12 months and grow and build and develop. But I think the CEOs of these companies need to be spending 25% of their time looking at what's out there. Like Nimrod said, you got to be looking for the opportunities for either tech or people or client acquisition. You've got to be doing partnerships. You've got to be looking at kind of a larger, what do I do after 12 months? And if you think that you're the CEO and you don't have to worry about it for 12 months, I think you're going to wake up in 12 months and either have lost some great opportunities or you're going to be in a lot of trouble. I think you just cannot avoid what's going on here. There's going to be some seismic shifts, and you're going to have to make sure that your company is part of that seismic shift.
Ido, do you want to add anything to that?
Exactly. I think I fully agree with Carine. What I'd like to add is the fact that I think the situation is even more complex for founders now, right? So the past year, they focused primarily on raising funds. Now they also need to look at partnerships, as you've said, also need to maintain the connection with potential fundraising for the next round. They also need to understand the market. There are less players in the market, so they got to reach out to potential customers and leverage that opportunity. And they also need to manage their talent, because if their current valuation and the feeling in the market is that all valuations are down, their top talent understands that they have a potential to go to a new startup and enjoy the hockey stick there. So they need to fully communicate what they're feeling from the VCs that they're communicating with about their current valuation to their top talent, and explaining to them that their stock options are worth something and the company is on a good trajectory. And because they have so much on their plate, sometimes some of those pieces fall between the cracks. And I think the situation is much more complex than it used to be several months back.
So it sounds like over-communication would be a positive trend.
Definitely. I want to add from what Ido said about the communication. I think that's a key that kind of founders have to focus on in the next couple of months, is kind of how do I tell this story to my employees in order to really get them on board and really get them focused in the direction that, we're moving the ship in the new direction now. How do we get everyone focused in that direction? And we see in the report that there's, a huge asymmetry of information between founders and their employees. So the founders we see in the past couple of weeks are really understanding that there's a huge shift in the market. They're worried. They're kind of adapting to the new reality. But employees are still living in the market of 2021. 68% said that they're not even worried, about their future in the company and what's happening going forward. So, we're seeing that asymmetry of information, that employees aren't part of the conversation, behind closed doors with investors, with clients. They know about how they're doing company, but they don't know about how the company's doing as a whole, and kind of how the economic shifts are going to affect valuations going forward. So I think in a couple of weeks, things are really going to start to sink in for them. And it's going to be really up to the founders to how do you communicate this to get everyone on board.
100%.
And that's part of the responsibility of the boards, because it comes with experience that you need in these times of distress to communicate even more than you used to communicate in the past, even if you feel that you don't have anything to communicate. So updating your top talent on meeting a VC and understanding that the valuation is 80% of what you experience, but the feeling in the media is that valuation were cut in half is a good thing to communicate to your top talent. But you need to be a really experienced leader to understand and to put yourself in that position. And I think the boards will have to step in and will have to mentor their founders and going through this
absolutely
process.
And I just Michael, you asked earlier, what is the behavioral shift? Like, what triggers the the crisis or the downtick? Also within a company and its culture, it's going to be one small event that sends the employees into a frenzy. And I just want to give an example of that event. And I think both Carine and Ido will really connect with this, specifically the share management platform that Carine has. Let's say you're looking at the cohort of employees in your company to whom you granted options in the last 2 years. At least the US employees, and in most Israeli companies, also the Israeli employees, they're going to get those options at an exercise price reflecting the fair market value of the shares at a certain exercise price. If they were granted in the last 2 years, that exercise price is high. One of these people, is going to leave in the next few, let's say, months. And they're going to realize when they need to pony up the money for the exercise price that their options are out of the money, because they're going to understand, they're going to collect some information. Some of it in Israeli companies, it's publicly available. You know what the last price of the last preferred share was in the Articles of Association. But if they piece it together, they might find out that their options are out of the money, even in a private company. And when they find out, they're going to be in dismay and they're going to tell their friends. And that sort of cooler talk around that could create a real forest fire within your company. So when I think when Ido says control the narrative and be an experienced leader, it's also dividing your employees into cohorts and seeing who are the employees that I brought in when the story was that I was telling was so big that it currently doesn't fit how the markets look at my company. Because that story wasn't only an intangible, kumbaya sort of thing. It was also, it has tangible aspects like within the exercise price of the options. And if you look at you look at WeWork, when you look at like a dramatization of it, like we crashed, all the employees are pissed off. But if you listen to Adam Neumann in an interview around this matter, he's going to say, no, you're missing the point. Here's where I missed. I missed on the employees that I hired prior to the IPO and gave them a really high exercise price. Those people got screwed and understood that without the IPO, their options are out of the money. Those people leaked all the bad things into the press. And that sort of that shed a very bad light on the entire company. Otherwise, the early employees still made hundreds of millions, tens of millions, or even billions of dollars in the small IPO that the company did. If you don't control the narrative, you don't communicate, that's how your company is going to get hurt in this process.
Incredible. It sounds like while the information may be there, it's accessible, you can know it today, part of the behavioral shift is going to cause some seismic waves that will take some maybe singular or multiple events to send ricochets down with information that founders and strong leaders can, in effect, make use of today and make their lives better, their employees' lives better, and control a little bit of the dramatic narrative that everybody's feeling, especially if, like you're saying, your company's stance is even a little bit better than what may be perceived by the outside world. That communication obviously is helpful. And I really want to thank all of you for coming. This was so enjoyable for me. I get to dive into technology in my day-to-day, mainly look at software and look at trends within the academic papers. And finally, I get to sit outside and to understand how this is impacting the larger market, the cyclical effects of it, the predictableness of it, but also the understanding that, yes, we will continue to participate in the cyclical nature because this is a part of the job and we don't have the crystal ball of when it's happening. And so those were some really monumental moments for me, as well as talking about talent and over communication and everything in between. So thank you very, very much for all your time. And I can't wait to share this with everybody. Thank you.